is a big part of the reason the S&P 500 hit a record high this week. Despite a global pandemic and double-digit unemployment, the stock market is soaring. First Financial's Chris Hagedorn talked about that surge with Courier Market Engagement Director Kelly Snyder.
Hi, Chris. Great to see you again.
Likewise.
So it's been a couple months since you've been here, and there's obviously been a lot going on in the market. Where do you currently see opportunities?
Yeah, so we recently wrote about a new theme we dubbed exact change. It was kind of a play on the recent coin shortage that businesses were facing. But really what we were referencing was potential structural change that we haven't seen in quite some time. And that is a backdrop where the dollar gets weaker and inflation begins to rise. The two go hand in hand. And one major reason behind that is that because when deficits in the U.S. expand, which they are, increasingly today, the dollar tends to weaken. And so if you look at the chart here, that's really what we're showing you. Twin deficits are the federal and the trade deficit in the U.S. relative to the size of our economy. You can see that most recent data point is really falling off the chart here, indicating deficits really kind of expanding significantly. And that suggests that the weakness in the dollar we saw in July may just be getting started. And so that creates opportunities actually in the investment markets. And we would highlight three areas. International markets, number one, tend to benefit from a weaker dollar because they get a tailwind from that trend from a return perspective. Real assets like commodities, including gold, tend to hold their value more in an inflationary backdrop. And then the commodity-oriented stocks benefit from the underlying improvement in the commodity itself. So that would be areas like industrials, energy, materials. These are all places that aren't very popular today, but that's why we think that they create a pretty unique opportunity.
So how about areas where there might be a little more risk?
Yeah, so kind of keeping with that theme of being a little bit more contrarian, we would say the areas that we're the most uncomfortable with are where everyone has wanted to be this year. One of those areas is long-term treasuries. They're up, believe it or not, over 20% year to date. That's a function of the fact that interest rates have fallen to very low levels. But we think going forward, very depressed interest rates combined with rising inflation, that's a dangerous combination for that security. The other area is in expensive growth stocks. And the poster child for this is what's now being referred to as the Fab Five. So these are the five largest companies in the S&P 500, which include Microsoft, Apple, Amazon, Google, and Facebook. I think we all know these companies very, very well. But today, these five companies make up 25% of an index that includes 500 companies. And you can see this now reflected in valuation. So if you look at the chart on this slide, what we're showing you is the valuation difference between growth stocks and value stocks through time. 10 years ago, the difference was very, very modest. Today, the difference is very, very wide, and growth stocks have become much more excessively prized. And so I think for us, it's important to remember good companies don't always make good stocks when sentiment has moved to such an extreme. This would be a space we're a little bit more cautious on.
Okay, that makes sense. Well, it was great having you, great information, and we look forward to seeing you again in 6 weeks or so. So thanks
so
again.
much. Thanks.